Welcome back to Out of the Rough. I'm joined by my friend Greg Kory. Greg Kory is a partner in Stern, Kory, Sreden and Morgan, an accountancy corporation. Welcome to the show.
Thank you, Fred.
I want to talk to you today about something that can be complex, and we'll try to break it down a little bit, but that is traditional slash classic IRAs and Roth IRAs. Tell us a little bit about the classic IRA or the traditional IRA. It's been around for a long time, hasn't it?
It has been around. The IRAs originally came into use in 1974.
Oh, that's not too long ago then? Yeah, our generation?
It's been a while.
Yeah.
They've been discussed for a long time. Everybody is aware of the classic IRA. There are many other forms that we're not going to discuss today, but from the standpoint of the classic IRA or the Roth IRA, they originally started in 1974 with the traditional IRA, and then later in 1997 they added the Roth component.
The Roth, they added that, and that really changed the game. Now there's a lot of exceptions, rules, limitations to it, isn't there?
There are, and one thing I want to say, somewhere in this conversation I probably am going to misspeak, and on top of that, the rules are far too complex to fully discuss here.
Right.
So those listening should consult with their tax advisors, their financial advisors, and maybe their IRA trustee before making any changes or making additional contributions.
Yeah, in detail.
To be sure that what they want to have happen does happen. The other thing I want to say is that I don't view the traditional IRA as a all solution to retirement. There's just not enough available contributions to satisfy what most people will need one day. So if your company has a 401k plan, or if you're self-employed and you can develop your own retirement plan, by all means consider doing that, and then look at the IRA as an addition or a complement to that plan. Now,
when I think of an IRA, I think of being able to contribute a certain amount. What's that amount for most individuals? Was it 4,000?
Well, for 2011, 2012, it's $5,000. If you're over age 50, you can add another $1,000 on top of that.
So
beginning in 2013, it goes up to $5,500.
It needs to continue to go up because it's going to be hard for us to retire if we're only saving $5,000 a year.
That is correct, and that's why if you have the ability and the opportunity to do a 401k plan at work, by all means do so, although that may limit the deduction you get for your IRA if you're taking a tax deduction.
If you're taking that. Let's talk about the difference between a traditional IRA and a Roth. And I also want to talk about the difference within a traditional IRA. There's some that are deductible and some that are not deductible. I wasn't aware that there was two different under the traditional IRA.
Correct, and that is probably one of the areas of the highest misconception with IRAs, and that rule's been around for a long time. The truth of the matter is most financial advisors have been, at best, lukewarm with the idea of a traditional non-deductible IRA. The reason it came into existence, or rather the reason its use has come into existence, is because if you're in a retirement plan at work, the government puts a limit on the amount of money you can earn and have a company retirement plan and be able to deduct your IRA. The reason many people would contribute to a traditional IRA was for the tax deduction. You put in $5,000, $1,500 is what it started at, and it's evolved over the years. Then you get a direct tax deduction, and in essence, the government, through either tax refunds or less tax you pay, is funding a third, maybe, of your IRA. So in that scenario, you would get a deduction for the money you put into it. But if you're covered under a retirement plan, and if you're single, 2012, between $58,000 and $68,000, you would lose your ability to take that deduction.
If your income's too high. Correct.
And for married filing joint, it's $92,000 to $112,000.
Oh, you got a sneak peek at those because they can be confusing, can't they?
You don't remember all this stuff. You always consult the cheat sheet somewhere along the line.
Exactly. Now, also, it's very specific about earned income.
Yes. An IRA contribution has to, you can contribute, as we said, up to $5,000, $1,000, $5,500 in 2013. But that's only to the extent you have earned income. If you do not have earned income in a year, you basically cannot contribute. Earned income is usually defined as income which is subject to either Social Security withholding for an employee or self-employment tax for the self-employed person.
So tell me an example of unearned income.
Interest, dividends, capital gains.
Okay. So some things we don't think about initially. So if you have quite a bit of that, but no earned income, it affects
the IRA is not available for you. That's correct.
Yeah. So let's talk about some limitations imposed. There's some income limitations imposed in 2012. No tax deduction when contributing on different amount of earnings, correct?
Well, yes. Well, let's go back to the traditional IRA and then maybe to the Roth with that question, because under the traditional IRA, if you could not take advantage of the deduction, there was still the ability to make a contribution to an IRA, do not take a tax deduction, but you have the opportunity of earning tax-deferred money until retirement. It's a little more complicated of a formula when you start taking distributions from that fund, because you have to evaluate the percentage of the untaxed money to the taxed money, and then that ratio is what you pay tax on when you take the distributions. Now, under a Roth IRA, you did not have that component of a non-deductible Roth. They're all non-deductible, but there's always been an income limitation to them. It's higher than with the traditional IRAs, but still that limitation eliminated the Roth possibility for very many people.
So a lot of people are earning too much money to be able to contribute to a Roth IRA.
That's correct.
Okay. So let's talk about the Roth IRA. You pay taxes on income.
Yes.
And you deposit it into a Roth IRA.
Correct.
And that money earns tax-free, and then you're not taxed when you withdraw it. Is that somewhat of a...
basically the idea behind it. There's a lot of rules along the way.
Obviously.
And there are some nice features of the Roth IRA.
So give me some features of the Roth IRA.
Well, the nice thing about the Roth IRA, one of the things I often have people would make an IRA contribution, and then they would come upon an occasion in their life when they're short of cash. They have an emergency need, and the only place they see to take it is their traditional IRA. There are a few scenarios where you can take money out of a traditional IRA and not pay a penalty in income tax. Well, excuse me, you always pay income tax, but there are some options where you don't have to pay the penalty. But those are very limited in scope. And if one of those situations did not apply, not only does the person pay income tax on it, but they pay another 10% federal penalty.
From the penalty.
So you can end up paying 50% on your distribution from your IRA. It turns them off of the IRA, and they never again invest in one. The Roth IRA has kind of a beautiful feature to it. And what it allows you to do, you kind of think of it as the money you put into your IRA is going into your right pocket, and the money it's earning going into your left. You can pull money out of that right pocket that you contributed at any time at any age, because it was your money, you never received the tax deduction for it, and you take that money out before being taxed or penalized.
And that's the Roth.
That's the Roth.
And
if you take money that you earn, it's still a Roth IRA, but you'd have to leave it in until age 59 and a half to be able to take it out penalty-free and tax-free.
A lot of people want to put a down payment on a house. Sometimes they're allowed to borrow from the 401k to do that. Does IRAs, do they allow for that?
There's a special provision in IRAs that does allow a first-time home buyer. And I believe the definition of first-time home buyer is someone who has not owned a home in the past 2 years, although double-check that.
Yeah, so in some cases it's 2, in some cases it's 3.
But in any event, you can take out up to $10,000 and avoid a penalty on your IRA withdrawal. In fact, under a Roth IRA, you can even avoid the tax if the money's been in there for at least 5 years. So you can take up to a $10,000 Roth withdrawal, use it to buy a first-time home purchase. It can come out of either earnings or what you put into it and be counted as a qualified distribution. Now, in your traditional IRA, you're going to pay tax on that money, but hopefully
because you didn't pay tax when you put it in most cases. In most cases, when it was deductible.
Except for the scenario of a non-deductible IRA, in which case it's probably partially taxable. But you can take out that $10,000, pay tax on it. Hopefully your deduction from your home mortgage and property tax will defray some of that tax. And at the same time, you don't have to worry about the penalty if it's used for a first-time home purchase, higher education, certain medical situations, very limited. And then there's a handful of other exceptions to the penalty.
We only have about 2 minutes, but I want to talk about one last thing. And I always hear that people are converting their traditional IRA into a Roth IRA. What are the advantages, and why would somebody do that?
Well, that's the new development that's just started to occur since 2010 for many folks. There's always been a Roth conversion available. Again, an income limitation of $100,000, which excluded a lot of people. Now anybody can convert. I mean, the government isn't being overly generous. They get to tax the money to the extent it's taxable.
They get it now, right?
Yes,
When you
they get the tax now.
So that's
you make the
probably
conversion.
why.
But
Right.
there's a number of reasons why you might do that. There are a lot of calculators available on the internet from your tax advisor and from your financial advisor where they can calculate a scenario where pull the money, convert the money, pay the tax, let it grow tax-free, pull it out at a tax rate when you retire versus leaving it all in there. Another reason to consider, this is an ability that's never existed before for someone in that higher income bracket to make a Roth contribution. Because let's say you have no IRAs. You can actually make a non-deductible IRA contribution and immediately, the same day, convert it to a Roth. You didn't qualify because your income was too high for a direct Roth contribution. But you do qualify for a non-deductible contribution, and then you can immediately convert it. Now, you might say, why the rigmarole? Because if you take that money out within 5 years, the government will come back and penalize you. You've already been taxed on it because you're never earned. But it's a great opportunity for someone to create a Roth without having the ability to do so because of income limitation.
Okay. The one thing I believe, Greg, and I've known you for some time, is I truly believe that in 15 or 20 years we're going to have higher taxes. And so possibly paying the taxes now might be a good idea. Really depends because of our situation with fiscal responsibility in our country. We might see higher taxes in the future. So that's something you really need to talk to your tax professional on.
That's correct.
Yeah.
And the beauty of the Roth IRA is it has other features, such as the ability to leave a tax-free legacy to your heirs. Because a Roth also has, as features of it, the ability to be passed on. There is no minimum distribution requirements, and it's available for anybody at any age, as long as you have earned income.
I'll tell you, a lot to deal with, but certainly you are the professionals at Kory, Sreden and Morgan for that. Greg, Kory, Greg, what's the phone number there directly?
It's 661-286-1040.
Appreciate you coming in. Thanks for all the information.
Thank you, Fred.
Well, I hope you enjoyed this segment of Out of the Rough. If you'd like to watch this online, go to scvtv.com or fredarnold.com. If you have some questions or would like a suggestion of a great guest like Greg, please email me, fred@fredarnold.com. I hope this information helps get you out of the rough and into success. Until we talk again, make it a great day. Bye-bye.